One of the most valuable lessons I've learned over the past decade in real estate is how essential it is to learn from the industry professionals. That's why I'm gathering professionals from across the country to share their experiences with you. This is a Gregerson's podcast, where experience and passion come together in the world of real estate. I'm Casey Gregerson, your host, and I'm very excited you're tuning into today's episode. As always, if you have questions for me or any of our guests, please reach out to me at casey@gregersonproperties.com. Now let's get started with today's podcast. Welcome to the Gregerson's podcast. I'm really excited for our guest today, who is Edwin Kelly. So Edwin he's actually the founder and CEO of Specialized Trust Company. This is a self-directed IRA company, which I'm really excited to share with you guys today, because I actually met Edwin at Collective Genius, which is one of my favorite masterminds I'm a part of. Actually met him in Tampa. We got to talking about self-directed IRAs, and I realized he actually owned and founded a self-directed IRA company. So I'm really excited to bring him on the show today to tell you guys and really debunk a lot of the myths about self-directed IRAs, really talk about how simple they are when everybody wants to make it really complicated, and just ultimately show you guys how you could ultimately make the next step in using your self-directed IRA, whether you have one right now or whether you're looking at starting one in the future. But Edwin, let's start today. Tell us a little bit about your background.
Yeah, so I'll give you the Cliff Notes version, but my journey actually began in finance, investing, money, if we just want to make it broad, right? Back in sixth grade, which if you can look at me now, you know that's a few years ago, right? I'm not a recent high school graduate. And but what happened was I was raised in Ohio by a single mom who was a social worker. If you know anything about social workers, you know they have big hearts and small pocketbooks. Well, we didn't have a lot of money growing up. And so in sixth grade, I started doing odd jobs, right, to make money, because she just couldn't afford to do a lot for us at the time. And so by middle school, I had saved up enough money, and I don't even remember exactly how I figured this all out, but I opened up an UGMA account, which is a brokerage account under the Uniform Gift to Minors Act, made my very first investment when I was in seventh grade, and bought my first stock. Then, interestingly enough, the stock went up enough in a year that I had made more money in 1 year investing than I did working all those crap jobs the year before. And I was hooked on investing from that point forward. I said, man, this is where the money is, and this is a lot of fun. The interesting thing is that stock story didn't have a perfect ending, because that stock ended up, even though I doubled my money in 1 year, I tried to sell it, didn't sell it. My grandfather wouldn't let me. He was the custodian on the account. And that company actually declared bankruptcy about a year after that. And so my investment, which I bought at 18 and a quarter a share, went to $42 a share, went to zero. Now, when you're in middle school, that's what we call a recoverable loss, right? We weren't talking about a lot of money back then either. But when you get into your 50s or 60s, that's very, very punitive. Continued my investing through high school, went to college. It's interesting. I just started taking classes on money and finance and investing. And what I knew, actually, I'll take one step back. One of the things that was very transformational for me was that in high school, right, I said, I want to become successful in life. But my mother didn't know what to tell me to do, right? So I didn't have a resource like that. So I went to the library. Now that's definitely going to age me now, right? Because I don't know that anybody goes to the library and uses card catalogs anymore. But I went to the library and asked the librarian, I said, hey, how do you become successful in life? Or how do you learn how to do that? And he said, well, you could read biographies of successful people. And I said, what's a biography, right? I didn't know that. So he kind of told me what a biography was. And I started reading biographies on all the old time greats, J.P. Morgan, Carnegie, Vanderbilt, Rockefeller, Aristotle Onassis. And I started to observe patterns in their lives. And so I had decided two things from that kind of venture or journey. And one is that I wanted to be involved with money and finance. And two, I had to own my own company, right? And so that was really the impetus of how my career began. That was a big contributing factor, because at that point I was always looking for, okay, what's going to be my niche, right? What am I going to pursue? And so when I started out my career, I started out like with Wall Street firms and did that. Um, and what I came across, in fact, that's the very first time I ever learned about distressed asset investing, right? You guys practice that in real estate all the time. But back then, there were investment managers. We learned to do it with companies and different types of assets and different things like that. The problem with those investments is that they were for accredited investors only. So in some cases, those were the best investments that I saw. They had, in my opinion, the lowest risk profile. They had the best returns, but people like my mother didn't have access to them. She didn't even know they existed. And so from that point, I said, there's got to be a way to duplicate what works, what I see, because I was in the private client wealth group. And so I was dealing with some of the wealthiest individuals, families, and institutions. And I saw what they were doing. And I'm like, well, how do you bring this to regular, everyday people like my mother, people like I was at the time, right? Mm-hmm. And that's where I discovered self-directing and self-directed retirement accounts specifically. But self-directing to me is bigger than just a retirement account. It's a way of operating. It's a belief system, right? It's a philosophy. It's how you live your life. It's the type of investments and things that you do and how we approach things. And when you combine that with retirement accounts and the specific benefits that the government gave us with those, like it's almost like magic, right? And so that's really what got me into self-directing. And then the last piece of this story is that I helped grow one of the largest self-directed custodians in the industry. And what happened was we just had a different vision of what self-directing could be and should be. And so that's when I decided to launch Specialized Trust Company with my business partner, Keith Marsh. And so we launched Specialized together back in 2015 and, have been helping people across the country ever since.
Wow, man, a lot there, Edwin. I think the first place I want to go is you kind of mentioned on like helping. There were these great investments that people were not able to get access to unless you were an accredited investor, but you're able to kind of solve that through self-directed. I'd love to hear kind of how you're able to do that and how other people can kind of do that.
Yeah. So one of the ways, and I'll tell you, there's a few different plays on this, but I'll give you an example of the type of investments that I was looking at back then and how people can leverage it now. So one of the distressed asset investments that I was looking at, and I talked to the investment manager. We actually had lunch one day, and I said, break this down for me. What are you exactly doing? So he said, well, and this is back in the 90s, right? So there was an airline that declared bankruptcy, but they were trying to come out of bankruptcy. And they had floated, companies have stock and they have bond issues. And so stock is equity, bond is debt, right? So somebody lends money to the company through a bond, they get an interest rate, and then they get their principal back at the end. Well, so what happened was when this company declares bankruptcy, the bonds basically, and in theory, right, you pay $1 for the bond or par, right? So if the value of a bond, say, is $1, when they declare bankruptcy, what do you think happened to the price of those bonds? They went down to like 10 cents on the dollar. Nobody would touch them because if they don't come out of bankruptcy, every dollar you put into that bond is gone, right? You forfeit 100% of your investment. So what this gentleman did was, which is really, it always amazes me how ingenious human beings are. Like people like are just capable of so much. So everybody's running away from this company, running away from the bonds, running away from the stock. What he did was he actually did the research, and bonds in many cases can be secured. So here's a key word, secured by specific assets. It turns out some of these bonds were what we call equipment bonds, meaning they were secured or backed by equipment. The equipment in this case happened to be the airplanes. So he went out and literally got the tail numbers of the planes that were used to secure these bonds, got valuations on the planes, and found out that with these particular equipment bonds, he could sell, if the company went bankrupt, right, he could take the planes and sell them for 70 cents on the dollar. He's only paying 10 cents on the dollar for the bond. if the company reemerges from bankruptcy and is successful, he'll get 100% of that bond back, right, at maturity. So he's buying these things at 10 cents on the dollar and ultimately receiving back an additional 90 cents on the dollar when the bonds mature, plus the interest along the way. When I saw this, I said, man, this is amazing, right? Because circumstances, there's nothing wrong with the planes, right? It was the circumstances of the owner that created this situation and this opportunity, right? So in that particular case, you have to be accredited. So most people would not even know that that's an opportunity or exists or be able to put money into a transaction like that. So how can we leverage that today? Well, the great thing is that because of the country's views and the founding fathers' views on real estate, that we are allowed to own land, we are allowed to own real estate, and that real estate is considered to be a cornerstone of wealth, there are not the same securities rules around real estate, right? So anyone, you and I, we don't need any kind of license. We don't need any particular degree or anything. We can all go out and buy real estate. We can all invest in real estate. We all have that opportunity. And so what we see a lot of clients doing is, again, being able to leverage that concept, but do it with a different asset. So instead of corporate bonds or equipment bonds or airplanes, you can practice that with real estate. You can practice it with note investing. I mean, there's all types of assets that you can apply those principles to. And that's the way that somebody doesn't have to be accredited, but can have access to the same types of strategies.
Wow. Oh, that makes total sense. So to go further on that, you think about investment that they couldn't get into with airplane example, and that company potentially going bankrupt, and only accredited investors, right? So now you could apply that to, hey, I'm going to go find a house or a property that is maybe distressed, or maybe it's a loan, right? Maybe it's a bank loan, or somebody has a note on a non-performing asset, but you look at the property and you say, hey, that property it's not performing now and it's run down. Maybe a tenant's been trashing the place, but I know if I take on that note and if I take over that property, I could potentially evict the tenant, and then you're buying the house at, say, pennies on the dollar, or buying the note at pennies on the dollar. Am I making that same kind of connection?
Absolutely. Absolutely. And look, this is your area of expertise. I invest in real estate personally. We have a lot of clients who invest in real estate all the time through their self-directed accounts that specialize. But I do not consider myself a real estate investor. I just consider myself an investor and an entrepreneur, right? But I'm happy to share my opinions, but don't take anything as advice here today, right? This is for educational purposes only. But the interesting thing is that, I follow financial data, economic data, I look at a lot of things. And the interesting thing is we're coming into a time where there's going to be a lot of distressed situations that people are going to need to resolve. I think I'm surprised it's taken this long, to be honest with you, but I think the government's been propping up the economy through a lot of things that, quite frankly, are outside of the scope of what they're supposed to be doing. But regardless, that's all starting to come to roost anyway, right? I think we're going to see that show up big time in 2024 and 2025. I get really excited about times like this because our business does pretty well. Investors and clients do pretty well with self-directed retirement accounts in good times, right? Because there's always different types of investments, opportunities, and things that you can do if you know how to do them, put them together. But in times of difficulty, and when I say difficulty, economic uncertainty, that's usually where we see the clients make the most money and buy the most assets with their accounts. So we're coming into what I call go time in the next 12 months. I believe there's going to be a huge opportunity for people to acquire assets at very favorable prices, right? And I think we're starting to see that develop already. So what is a self-directed IRA, right? So some people, I'm sure, are very familiar with that concept. Some people listening right now might have a self-directed account. Some people, this is completely new information, right? So I group retirement accounts, or IRAs. I'm going to use IRA as a general term, right, as we talk. But IRAs I group into two categories. So the first category is what I call a plain vanilla IRA. That's what most people have. So a plain vanilla IRA is one that is held at your traditional bank or brokerage institution, a Wall Street firm like I used to work for. And they restrict us to investments that they can charge commissions and fees on. So things like stocks, bonds, mutual funds, and CDs, right? However, by contrast, a self-directed IRA is an IRA that is held at a specialized custodian, hence the name of the company, right? Real clever. Specialized custodian that allows you and I to invest in anything allowed by the government. So believe it or not, there's only a few things that we're not allowed to invest in. For the most part, we can invest in all kinds of things. So buying real estate, investing in real estate, as an example, is something that we can buy inside of a retirement account. Notes, physical precious metals, cryptocurrencies. I mean, you name it, you can pretty much purchase it inside of a self-directed retirement account. And so what I tell people is, if you can do it outside the retirement account, you can do it inside the retirement account, right? So with that in mind, what are the reasons, and then this will transition us into how do you start. What are the reasons that people are looking at self-directing? Well, particularly in difficult times, like I mentioned, right? When the economy goes down, understand the stock market goes down, right? And the reason why people are opening up self-directed accounts even during good times in the stock market, because I have these conversations every single day. I have clients who are in their 50s like me, and they'll say to me, I just got back to where I was in the last downturn. I know there's another one coming because I've been through enough cycles that I just know this is what happens. I'm at a stage of life, I can't afford to let that happen. I got to get out and do something different. So that's one reason why people are looking at self-directing. Another reason why people are looking at self-directing is that they're diversifying. So maybe they want to own some stocks, bonds, mutual funds, and CDs, but they also want to own some other types of assets so that they're diversified and kind of insulated from that. That's the second reason why people consider self-directing. But I could distill all that down to this, and this is really the benefits of self-directing, is that when I'm working with most clients do not have enough passive income or cash flow coming from assets other than their W-2 job, right, or their business. They don't have enough income or cash flow coming in. So to be able to stop working at some point, they need to have more cash flow. To do that, they need to grow their asset base, right, to spin off more cash. But to grow your asset base, to grow your nest egg, you first have to be able to keep what you've already accumulated. That's the risk of the stock market, right? When it goes down, we're not keeping our base. So we need to generate additional cash flow by growing our assets. But to grow our assets, we have to keep the assets we've already accumulated. And to do that, we have to get complete control over our money. That's ultimately what a self-directed account does. You and I get complete control over our own money. So how does somebody start? Well, it kind of depends where you're at. But the starting point is really pretty simple. If you're talking about just opening an account, that can be done over the phone, over the internet, right? DocuSign, we're all familiar with that kind of stuff. And you can set up a self-directed account in an hour, or less. So the process to that is actually pretty simple.
You were kind of transitioning to like, how do they actually use it, right? So you talked about the benefits and like how, really, I like it. If you could do it out of the self-directed IRA, you could do it in the self-directed IRA. Great way of like simplifying it. But yeah, tell us more though, Edwin. Now that you're ready to go, you've got the account, you set it up, or you did the initial setup, right? Which you said is just submitting an application, but now you're ready to go actually purchase something or lend on something.
Yeah. So I'll tell you what. So this is the interesting thing about self-directing. I hear different things about self-directing. One of the things that I have heard is that self-directing is complicated. I don't agree with that. And I'll tell you why, because I'm going to walk you through the process. And it really comes back to understanding how this really works. It's a simple 3-step process. I call this my triple D process.
Love it.
Okay. Love it. First D, decide. Okay. The first thing that we all have to do is decide, do we want to take control over our money? Do we want to build more wealth? Do we want to save and preserve our wealth and money from taxes and creditors and, things of that nature? Because retirement accounts do help us do all that. Do we want more for ourselves and our family, right? Because these accounts basically give us that opportunity. So the moment you say yes to those questions, if that's what you're looking for, then you have decided to establish a self-directed account. So that's the first step, which I said happens over the phone, over the internet, super simple, set up, takes less than an hour. The second D is to deposit money into the account because we have to have some money to work with. So there's 3 ways to deposit money into a self-directed retirement account. The first is a contribution, right? Which is where I take money from my savings account or checking account. I deposit it into that account. Second way I can do that is to transfer money from another IRA, and I can transfer all of it or some of it from a bank or a brokerage into a self-directed retirement account. The third way to deposit money is to do what's called, most people call it a rollover. Okay. Different terms mean different things to different people. But what most people mean when they say rollover is that they're going to take money from an old 401k, 403b, TSP, and move that into a self-directed retirement account. So now we've accomplished the first 2 steps. We've got an account established. We've got money in the account to invest. Now, the third step is to direct, right? And this is what makes this a truly self-directed account, because it's in this step that we get to tell our custodian, hey, this is what I want to put my money into. This is what I want to purchase with my money. This is what I want to invest in. And they execute our directions to them. And that's it. That's the 3-step process. Now, I'll give you one more bonus step. Fast forward in time a little bit. The fourth and the bonus step, and this is the best one of all, is the distribution step. Distributions is a term that is used to when we take money out of the account to spend on anything we want, right? Taking a cruise, buying a new house, right? Whatever it is, going out to dinner, that's called a distribution. And that's where we take money from the account, put it back in our own account. And that's the bonus step, right? That would be considered the 4th step in the process. But that's it. The 3 steps and you're self-directing.
Love it. Well, man, we're going to break down all those, but I'm most interested in the distribution part. So I know this is probably depending on the type of account, but what does that look like if it is a retirement account or not a retirement account? What are the kind of stipulations there that you work with?
Yeah, so I'll say that it depends on the account, but generally speaking, there is an age requirement that needs to be met of 59 and a half. If you're 59 and a half or over, then you get to take what's called a qualified distribution in most cases. A qualified distribution is a technical term that the government uses to say, hey, that's where you get the best tax treatment on the money you pull out of your account based on the type of account you have, right? So 59 and a half, unless I tell you otherwise, which I'm not going to do today, that's the core requirement. The reality, though, is this, and this, in fact, I'm going to be talking about this later today on a separate call. But the great thing about retirement accounts, and this is one of the things that people don't realize, you always have access to your money, right? If you said, I want to pull all the money out of my account, you can do that regardless of age, anytime. That's not really the issue. The issue is, how is it going to be treated from a tax standpoint? That's really the issue, right? So we work with clients all the time, and there's clients who say, hey, look, I don't want to wait till I'm 59 and a half. I want to take money out earlier than that, right? Well, okay, there's strategies that can be looked at that can allow people in many cases to do that. So there's all kinds of things. The key thing is like I said, on that front end, deciding what kind of benefits you want, because there are different accounts, different tax treatments, and then establishing the right type of accounts for what you want to accomplish.
Got it. That's interesting. Because my understanding was you were always going to probably take that 10% penalty if you touched it before 59, but without going, you don't have to go into super detail, but there is a strategy to where you can actually get access to it without, or are you still going to pay that 10% no matter what? And you're just
no. There's ways to avoid the 10%.
Okay.
Now, I want to be clear about that. That doesn't mean everybody can avoid the 10% all the time, right? And it depends. But the other thing that I tell people is, so here's what I generally tell clients when I'm working with them. I say, look, if you can explain to me what the end result looks like, I can usually figure out a way to get us there, right? So I would say begin with the end in mind, because a lot of times people know enough, or they hear a little bit, enough to be dangerous, so to speak. So they'll say, hey, I want to do this. And they'll talk about a process or a transaction and how they're planning on doing it. And oftentimes it violates all kinds of rules. And I say, listen, look, take a step back. Forget about all that. Just tell me what does success look like for you? Explain that to me, and then let me help you understand the rules in the context of what you're trying to accomplish, so that you can do this in a very compliant and correct way. And so again, you can't do everything, but most things, you'd be surprised how much freedom and flexibility you have when you really understand this stuff.
Got it. Cool. Well, I'll give you an in scenario. You can give us your advice, Edwin. So say I've got a strong W-2 income. Maybe I'm not a full-time real estate investor, but I've been interested in getting into real estate, want to get some exposure. But again, work in a good, like I said, I keep coming back, have a good W-2 income, maybe have a 401k, maybe have some money that could be moved to self-directed. But how would you but say my end goal is say, hey, I want to get some exposure to real estate. And and I want, because in real estate, I love the fact that I get appreciation. I love the fact that I can get cash flow. I love the fact that I'm going to pay down a mortgage potentially. Like I want all those benefits of real estate, but I want to use it with self-directed and ultimately grow my wealth over time. What would your strategy for that be?
Well, so the first thing that I would do is I would say, okay, let's figure out which account is going to be best suited for you. Understand that most people have an account. They don't even know why they have the account. The reason why most people have the account they do is because they started a job. They checked the box on a piece of paper that said, take 10% out of my paycheck and deposit it in the 401k plan, right? And so that's ultimately how they have the account they have. So we start at the very beginning of the process to say, look, we want you to understand the different types of accounts out there, the different types of benefits that they offer. And so let's start with the right account, right? Because once money's in an account, we can move it into all kinds of accounts. So that's kind of step number one. And then step number two, when we're talking to clients, is to figure out what's the best way for them to move forward investing that account. So a lot of the challenge is that a lot of people, I think, operate under the false assumption that self-directing means doing it all alone. That's not what self-directing means at all. Okay. So I'll give you an example of something I do. So I'll just speak to what I do. I'm busy running Specialized Trust Company, right? This is my primary business and currently my primary source of income, right? So I'm busy doing that. I don't have time to go do what you do. So what do? I will partner with people like you that are actively out putting together deals, know how to buy real estate, know how to exit that real estate, whether it's a buy and hold strategy where you're cash flowing or you're rehabbing and selling, or you're converting, a building to one type of use to a different type of use, right? There's all types of strategies. Land, right? Buying land and in the path of progress in 5 years, selling it at a big multiple. Lots of different plays, but that takes specialized knowledge and expertise, which I don't have the time to go out and develop, but I do have money in an account. So I can leverage people like you who have an expertise in a certain thing and invest alongside of you or with you in different ways, right? Investors structure these things different ways. But now I'm leveraging your time and your talent. In fact, I'll just say something about that from a principle standpoint. There was a book written several years ago, and the premise of the book was the guy said, look, I want to understand the top 1% wealthiest people in this country. How did they get that way? What he found and reported in the book was that 74% of the top 1% of wealthiest Americans in the country got that way only one of two ways. Number one was investing in real estate. Number two was owning a business. Now, what do those two things have in common? They both leverage money and people, because people provide expertise and time that we don't have. That's what enables us to move beyond our own resources of our own time and our own money. That's how you really create a lot of wealth. And so I'm not the smartest guy in the room. I always say that. I look at people who are way smarter than me, who have way more experience than me, and have figured this stuff out. And then basically I just look for those patterns and then I duplicate what they do. And that's basically what this is, right? So I figured out, hey, I don't have to be the real estate expert. I just have to build relationships with the real estate experts. Yeah. Because every real estate investor I know has a need for capital to do more and more deals. So that's one way to do it. Again, if you don't have a lot of experience, if you don't have a lot of time, you can invest with other people who do have that experience and are spending the time on it. Another way is to do it yourself, right? You go out, you buy a property, you rent it out, or you fix it up and you sell it, right? I mean, so there's all degrees of this. So you can own every step of the process from beginning to end, or you can do it in a more passive way, which particularly when it comes to retirement accounts, I'm a big fan of, right? I don't want another job. I want to build wealth and protect my money, right? I want to preserve my wealth and grow it over time. Retirement accounts are great for that. And we can do that in a very passive way when you understand how to put this process together.
Love it. Okay, so I love the example. I want to dive deeper, Edwin. So we'll talk about the 3Ds, right? So you've kind of decided that you want to partner with another investor who has the time and is capable in finding deals, right? So that's your decision. You've deposited money into your account. Maybe you brought it in. Maybe you brought in rolled over an IRA, or you've been making deposits, but you got some sort of sum of money you're ready to invest. So what would that look like? And maybe we'll just talk on the debt side first, and then you can give us some other examples too that you think have worked well for people. But what does that kind of work look like on the debt side if you want to partner? Say I've got a project where we'll give an example right now. I got one. So I got a project needs $50,000 to go do the rehab, and I'm looking for a private money lender. But how would somebody use a self-directed to actually lend on that?
Yeah, so it's a great question. I'll talk to it from both sides. I'll talk to it from your side as well as the IRA investor side, right? So on your side, you're looking for $50,000. Now, you as the investor, and this is the great thing again about self-directing, is that you get to structure the deal or the investment in whatever way is going to benefit you and the investor the most. So you might say, hey, this is going to be a $50,000 loan. So I'll borrow the money at $50,000. I'll borrow it for this amount of time and I'll pay this amount of return or interest. I will secure it with the real estate or I won't, right? It can be secured or unsecured. It depends which way you go. Now, from the IRA investor side, somebody with an IRA might say, hey, look, I'm a big believer in real estate. I want to invest in real estate. I have $100,000 in my account. I don't know what I can necessarily buy for $100,000, and I'm not sure what to do exactly. But I know I like real estate. I like the premise of real estate. I know it can hold its value. I know that it can go up in value. I know that it can generate cash flow. So now here's somebody, right, who has this need or has this interest. And by the way, they're going to compare this to what they're doing now. So if you said, hey, I'll give you a note at a stated rate of interest and it's secured, well, you're offering some benefits to that IRA investor that they're not getting in the stock market because there's no security in their mutual fund portfolio, right? That can drop whatever it drops next year. So security is one thing that investors respond to, right? It's like, hey, my money's secured by this actual asset. And the second thing is that there's a stated rate of return and there's a time frame where that comes due. So it allows somebody to take advantage of the benefits of real estate without having to put all the time and effort into doing all the work themselves. So there's a win for the IRA investor. There's a win for the investor putting together the investment. And that's why we see so many transactions that are basically that type of thing. Like I said, the great thing about it is when I do investments, people say, well, hey, here's what I want out of the transaction. I say, okay, here's what I want out of the transaction. And a lot of times it's just a back and forth discussion. It's like we agree, like, yeah, this is what we're looking for. So unlike Wall Street, where they dictate all the terms, you buy this at this price and it's going to do whatever it's going to do. Okay, I have no control or say in that at all. By contrast, in this world, right, you and I could hammer out a deal together and we come to something that works for both of us and now we're both happy. Would have the name of their IRA on it, not their own personal name. They would send that to us and say, send the check to Casey. I mean, that's basically the process. When if that's a flip, let's say, and you sell that property and you pay that, you would send a check to the name of the investor, which in this case is the name of their IRA with principal and interest. It just gets deposited in their check. And oh, by the way, the gain on that is 100% tax protected because it's within the IRA.
Love it. Man, you nailed it, Edwin. So I was just about to say mechanically, how does it work? But to recap, let's say we decide on terms, right? Say it's the $50,000 investment. For easy numbers, we're going to say it's a 10% interest rate for 6 months, right? So to start off, to reframe this, the initial step is you set up, so typically we'll set up a promissory note and a mortgage. And what you're saying is you would list, not Edwin himself, right? Edwin's going to list whatever the name of his self-directed IRA is. He's going to list that on all those documents. He's going to then wire, I guess the self-directed custodian would then wire the fund, or you would request it, right? As the self-directed IRA account holder, you request, hey, here's the documentation, provide it to you, and then you'll send it to the title company at funds. Am I missing any other steps in there?
Nope, that's basically it. So the form that we have, and by the way, customer service is great at this stuff, right? So we have a form called a DTI, right? Not to be confused with DWI, DTI, right? DTI, which stands for Direction to Invest form. It's only 2 pages. And basically, it's pretty straightforward, right? The first box is your name and address and your account number. And from down there, at the very bottom of the first page, it says, what are you investing in? And so there's different options: real estate, LLC, note, right? So they check note. And it says, okay, well, if you're investing in a note, we would expect you to provide a note with this form, which you probably created, right? And then it would say specialized trust. Again, the investor's name on that note would be Specialized Trust Company, FBO, for the benefit of John Smith's IRA, and the account number. He submits it, or she, then Specialized executes that direction. It says, hey, wire this amount of money, $50,000, to this title agency by this date. Wire goes out. That's it. The investment's made. I mean, the interesting thing about it is that people think this is a very different process, but the truth is they're already doing it. They just don't realize it.
Yeah.
Because in one sense, I think every single account out there is self-directed, right? If I choose to hire a bank or brokerage and a financial advisor, I'm establishing my account there. I'm then sending them my money from wherever it's at now. And then the third thing is, if I'm using an advisor, I'm saying, hey, you make all the decisions, right? If I buy a mutual fund, there's an investment manager on that mutual fund. The investment manager is making the decisions. But I directed the money there. I told them, buy whatever you buy. It's the same exact process. It's actually no different than what people are already doing. It just seems different, but it's more similar than it is different. And people figure that out once they step into it.
Wow. Yeah, I mean, it makes total sense. I love that analogy. You're depositing, like you say, the same 3Ds. If you were to go deposit in a brokerage, you're deciding what to do, you're depositing it, and then you're telling them to go do whatever with it, right? You're not directing it yourself, but you're also like, hey, say you want to move transactions or move to a different fund or move money around. Yeah, it really is the same. You're just asking the self-directed IRA and filling out that 2-page form, and you're going. And then again, it's just a difference of the name on the title. It doesn't say your name. It says your trust name or your self-directed IRA's name, and you're off and running. So the last thing I was going to ask on this, you're rolling through the process. So you fund it and you get into the deal. And I love how simple you made it. But basically, so say once you finish the deal and you pay it back, you kind of touched on this, right? So say we finish the flip. Now we're ready to pay the investor back. We will, I guess, go through the title company again, because you'll have a formalized mortgage, right? The mortgage is recorded at the county. So we go to sell this flip or sell this project. So then the self-directed trust would get paid out at closing, right? Money goes back into the account. And that's simple, huh? Then you're just ready to...
like the title agency cuts the check and they just go off the paperwork. So they literally at closing will just cut a check to the IRA and send it to the office, and we receive it and we just deposit it right back into the client's account, right? And so think about it this way. Investing, this is what I figured out over all these years, right? My grandmother used to call me a simpleton, and I don't know that she meant that as a compliment all the time. But I've learned that it's a tremendous asset, because when things are simple, I can do them, right? So I like simple things. There's only 2 things. And by the way, so let's boil this down. When you're thinking about investing, whether you're using a self-directed IRA or not, this holds true, but we'll talk about self-directed retirement accounts here. When you're an investor, you can only do one of 2 things. There's only 2 roles you can play. You can be an owner or you can be a loaner. That's it. So when you understand that, it's like, okay, those are the 2 roles I'm going to play. In this case, I'm going to be a loaner because I'm lending money. From a transaction standpoint, there's only 2 types of investment transactions you can make. You can buy or you can sell. So when you fund the note, right, I'm sending money to the title agency. You're buying that note. When the note pays off, basically, you're selling the note and exchanging it for the cash and the return. That's it. I mean, the process, like I said, it shocks me when people talk about, oh, well, I've heard this is complicated. I don't know. It doesn't seem that complicated to me. Maybe you're just talking to the wrong people, but this is the point. And this is, I think, one of the reasons why our clients have so much success is that when you educate people on how it just fundamentally works. Look, Wall Street has a vested interest in making things complicated. I'll never forget the first sit down I ever went to with a financial advisor with my grandfather. And I was in high school at the time. And we sat down, and this guy started talking about beta and alphas and standard deviation and how he sees certain things and ratios and he's in love and that's what he's buying and that's why my grandfather should give him some money to invest. We walked out of there And my grandfather said, "So what do you think about that guy?" And I said, "Well, I don't understand anything he talked about." And he says, "Yeah, neither did I really." So guess what my grandfather did? My grandfather did nothing. That's the point. A confused mind never invests. When we really get things down to fundamental principles, when you really understand what transactions look like and what they are, it's very simple. And so in this world, people can act on that. I believe Wall Street, and again, I came from that world, so I know, has a vested interest in making it very complicated, because the more complicated and complex it is, the more you need an expert to help you with those things, right?
Yeah.
But the reason why I love self-directing is because what I have learned is that nobody cares more about my money than me. Nobody cares more about your money than you. To be honest with you, I would love to write a check and hand it to somebody and say, make me rich. But the reality is, it doesn't work that way. So the way to create wealth and to create independence and live a life with dignity and respect, quite frankly, is to own the knowledge ourselves and to make our own decisions. Because for better or worse, nobody out there is going to do it for us. We have to be the captain of our own ship.
Love it, man. Great. Yeah, that's such a good way to summarize it. You get to control it. No one's going to care. No one's going to underwrite. No one's going to, and underwrite, maybe people feel like they need to know how to underwrite. I had this conversation the other day where it's like, hey, I'm not quite sure how to do the deal. I'm like, well, you can reach out to other people, other investors, and you can get guidance. You can get help pulling comps, help pulling, like, you can feel good about the deal. But when you go through the process yourself and you're actually understanding it and you're knowing your own risk tolerance versus somebody else deciding that for you, I agree. That's so powerful, Edwin.
Yeah, I mean that's why I say it changes lives. I mean it really does. And we haven't even gotten into a lot of the benefits of self-directed accounts, but I can tell you that they're numerous. But I think we've touched on the most important one, which is you get control over your money. And what I can say as a general thing about retirement accounts is that they provide a lot of tax protection, which enables us to grow our wealth faster and larger, exponentially so, than not using them. The second thing is that we can invest in things that we know. And if we don't know certain things, we can learn those things and we can make better choices for ourselves. That's my premise.
Wow. Yeah, I was going to go next. Edwin, is just making sure we covered all the benefits. Any other big ones that you've kind of found for your clients and customers or people that are doing self-directed?
Yeah, so a lot of people don't realize what the tax benefits look like, but I'll give a highlight with Roth accounts, and a lot of people might be somewhat familiar with Roth accounts, but I can summarize the tax benefits of a Roth account this way. A Roth IRA allows us, is the only legal way I know, to go from forever tax to never tax, forever tax, never tax. Because if let's say you bought a property inside, and let's just say it's a rental property. You bought a property inside of a Roth IRA, and it spins off $1,000 a month. That $1,000 a month, assuming you meet, you take a qualified distribution like we talked about earlier, that $1,000 you can take out every single month. It comes out 100% tax-free. No income tax, no capital gains tax, no tax at all, right? You literally go from forever tax to never tax when you build assets and income streams inside of a Roth account. So tax benefits is one, and that's what most people think about. But I'll give you another one that to me is equally, if not more important, and that is asset protection. Now, I'm going to make a general statement here about the asset protection features or benefits of these accounts, because certain accounts you have to look at on a state-by-state basis. Certain accounts are protected at the federal level. But generally speaking, your retirement accounts are pretty much judgment-proof in all 50 states. So what does that mean? Let's say you have a personal bankruptcy. The court cannot attach a judgment to any asset held inside your retirement account. You could have a business go bankrupt. The court cannot attach a judgment to any asset held inside your retirement account. You could be tried and convicted of a criminal offense, and the court can take your life, but they can't take your retirement account. Now, that doesn't seem right, but that's the way it works, right? So I'll give you a real practical example. When COVID hit, I had a client who had short-term rentals, right? So her business model was Airbnb down in Florida. In her self-directed retirement account, she owned long-term rental properties, right? Most of which were paid off or nearly paid off. When COVID hit, right, all those cancellations took place. She ended up within the first quarter, after March, right? So second quarter of the year, but first quarter from declaring the shutdown, she ended up having to declare a bankruptcy on that business. But the income that she was generating in her retirement account was untouchable. The assets, untouchable. So she still had a stream of income coming in that nobody could take from her. So if you think about, when we talk about preserving wealth, a lot of people think about taxes, but there's a lot of people out there, right, who might try to take things that we accumulate over our lifetime. And so retirement accounts provide a huge asset protection benefit. The third and final benefit, there's other benefits, but I'll just leave you with this one: estate planning. So are you married? Okay, so you're married. I'm getting married. By the way, one of the questions I always ask people when I talk about this stuff, I say, who lives longer, husbands or wives? What's your answer?
Man, that is a good one. I'm going to go wives.
Yeah. Statistically speaking, that's true, right? So wives outlive their husbands by a significant margin, right? Statistically speaking. So what I tell people is wives are killing off the husbands, right? That must be, right? Statistically, that's what it says. But here's the point. So let's go back to that Roth IRA example. Let's say I own a couple rental properties in there and it spins off a few $1,000s a month in income. My wife is going to outlive me statistically. So what happens to her when we pass? Well, that Roth gets retitled to her. So if I pass, the very next month, that distribution check gets cut to her, not to me. Life goes on. We've taken care of the people that are most important to us. And so there's a lot of estate planning type of benefits. All of these benefits are packed into these accounts for one low, simple fee. Most people aren't aware of all these things. So that's a big thing that we do, right? Is show people how to build out estate plans, asset protection plans, wealth preservation and wealth creation plans using these accounts, because there's just so many benefits that are contained in them. Most people don't even know that they exist. The good news is, if you have a retirement account, you're getting them all already, even though you may not even be aware of it.
Got it. Man, I hadn't even thought about that. I mean, I thought it from the perspective of, like, a lot of times people buy they'll 1031 exchange rental properties, right? And they'll trade up. Their goal at the end of their life is to put it into a trust and pass it down to their kids and have it all untaxed, right? Which can be done, but there's a lot of dominoes that got to fall, and you always got to be buying, and you always have a lot of stipulations, right? But I guess what you're saying, a simpler way to do that is keep buying that asset in a Roth and keep it in there, and you get the same perk, and you don't have all those restrictions of a 1031, right?
Oh yeah. Well, so it's interesting because I was just talking to a client the other day about 1031s, and what I'll say is that a self-directed IRA is a piece of your puzzle. It's not the entire puzzle, right? There's other things that we do, right? Having said that, though, a client asked me the other night at dinner. He was asking me. He says, "Well, what do you think about 1031 exchanges?" And I said, maybe in the right circumstances they're good, but I said, here's my big problem with the 1031 exchange. And I said, I've been on both sides of these transactions, so I know. I said, but what I find is that I make my best investments when I'm dealing with motivated sellers, not when I'm a motivated buyer. And that, to me, that's the biggest problem with 1031s. I've seen, and I've participated in transactions where people have made horrible decisions because they didn't want to get hit with the tax and they needed to place the money and they had a hard deadline. Self-directed retirement accounts are tax protected. So you can sell that property and you never have to reinvest it if you don't want, or you can do it 30 days later, or you can do it a year later, but you're not paying any penalties, right? There's no ticking time bomb, so to speak. There's no noose around your neck. So it's kind of like when you do investments inside of a self-directed retirement account, it's kind of like doing a 1031 exchange in terms of the tax benefits in some ways, but you eliminate the downsides.
Love it, man. Great way to put it. Well, I think, Edwin, we've done a really good job of explaining like how simple it is to start it, like all the benefits. I think the last two are like, what does the cost and fees look like in general? And then the second piece would be timing, right? The timing from when you start, like what does it take to set up the account? How long does that take? And then when I say next step is when I pull the trigger, I want to invest $50,000 in this property as a loan. What does that transaction look like in timing?
Yeah, so good. Those are both great questions. So in terms of fees start a little over $200 a year and go up from there based on the account value. Now, one of the things that I'll explain about that just real fast, and we have staff that will go over the fee schedule, they go over everything. And so, and different accounts have different fees. So, you can look at that, but just to give you an idea, right? Fees start a little over $200 and go up from there. I'll tell you that most people don't know what they're paying in fees at the bank or brokerage. Self-directed fees, and this is true across the industry, by the way, self-directed fees are usually a half to a third of what bank and brokerages are charging for these accounts, right? So another reason why people like self-directing is because the moment they move money into a self-directed retirement account, they instantly save money on fees, like every time. It's just most people don't know what they're paying. With self-directing, you see the fee schedule, you sign off on the fee schedule. I think if you're going to pay for a service, you should know what you're paying and what you're getting, right? Like that's just kind of common knowledge, but that's not the way Wall Street works, right? They hide the fees. The second thing is that the way fees are calculated in Wall Street is that it's basically a straight line. We charge this amount of money or this percentage times your assets. It doesn't matter what kind of assets you have. By contrast with the self-directed world, although the dollars go up as a percentage of assets, as your account grows, the percentage comes down, if that makes sense, right? So self-directing is a tremendous value for the money. That's one thing. And then in terms of timeframes, like I said, we open up the account same day, pretty much, right? So to get started, that doesn't take any time. What does take a little time is to transfer the money from where it's at now over to your self-directed account. So there is a time frame for that, right? We take care of all of that for you. I always tell people, don't do that on your own, right? Let your new custodian do that for you. That's the best way to move money. That way, everything comes over dollar for dollar, right? No taxes, no penalties. We know how to do that. Most clients don't. Let us do it. That's what you pay your fee for, right?
Yep.
And what I tell people is just because of that time frame on the transfer process, it can take 2 to 4 weeks before the money is in the account and available to invest. So if this is something that you think you want to do, here's how I put it. No account, no money, no opportunity. You have an account, you have money, you have all the opportunity in the world. So if you know it's something you want to do, get started because there is a process. And then from there, things will start to come together.
Got it. That makes sense. So 2 to 4 weeks on the front end, but like, what's he say? Just get ahead of it, get it started. And then let's say, well, first, one question first. Say you want to add to it. Is it a 2 to like, is that pretty fast, streamlined? Like, hey, I'm ready to transfer more money into the account to invest with on the self-directed, like to deposit more?
Yeah, so that's one of the things that we do as well. So one of the things that we do for clients, one of the services we offer is what we call custom plan design. So that's where we will take a snapshot of you as an individual, your family situation, and your professional or business situation, and we'll actually create a map based on what your goals are, what your snapshot looks like. Create a custom plan for you, your family, and your business, and then show you how to maximize the money into that plan. And then some clients implement it all right away. Some clients implement it in pieces over time, right? It all depends on everybody's individual circumstances, but that's why we call it custom, because it's created uniquely for each individual client, and the way that each individual client implements it is entirely up to them.
Got it. Love it. Yeah. So you could streamline that. And it's, again, like you say, you pay the fee and then you utilize it. You have them help it manage it. So the last piece is, Edwin, now you've got it deposited, or again, back to our 3Ds, you've decided, you deposited, now you're ready to direct, and you decide, hey, I want to move forward with this investment, 50,000 with this operator, and you've got your promissory note, you got your documents ready. Assuming you have documents ready, what is the timeline to actually be able to fund with that?
That's entirely up to the client. But what I can say is that we work with a lot of different investors out there. And I'll just tell you what one told me a couple of weeks ago. I was talking to him, and it was actually in a mastermind group that I'm in. I'm not CG, different one. CG is great, but I belong to a few. And we were talking, and he says, I just have to tell you, he said, we sent over three investments last week for investors that we're working with. He said, do you know that you guys process those in less than 5 hours, same day?
Wow.
And I said, well, I'm glad to hear that. But same day processing is one of the services we offer. Standard processing is 3 days because it all depends on the client's time frame. If they say, hey, we wanted this done today, all right. If you want it done tomorrow, that's fine. 3 days, that's fine. I mean, it's really directed. Again, this is the great thing about it. It's all directed by the client.
Yeah. Oh, that's huge. Because as we know, like especially many investments, but especially in real estate, it's all timing. And there are some times where you're under the gun and you got to go. And it's good to you want to have a self-directed IRA company that can perform if need. Not ideally, that not everybody wants to do it in a day, but then knowing that it can be done, that's huge.
Yeah.
Cool, Edwin. Well, to kind of wrap this up, anything else you want to kind of share? I think you've summarized it again well. I keep coming back to your 3Ds: your decide, deposit, and direct, and at the end, getting to distribute. But anything else you would say to people that are maybe still on the fence, and have been thinking about a self-directed IRA. I think you've put away all the myths and taken away all the complications. But any last thoughts?
Yeah, so I'll share this as kind of like the closing thought is one of the advantages of self-directed custodians, and specifically, I'll just speak to specialized trust company because I don't run the others, right? So I can speak to specialized trust company. We are what's considered a passive custodian, meaning we do not sell you any investments. We don't advise, steer, or recommend any particular investment or investment strategy. What we do is charge a fee for the account, and the only income that we receive from any person is from the client themselves. And that's a huge benefit. And I'll tell you why. Because we sit on the same side of the table as our clients. I don't get money from investment sponsors. I don't get money from anybody else, because to me, that clouds it. One of the challenges that I saw in the financial services world, and I've had clients say, I'll ask clients, well, do you know what your financial advisor charges you right now? Or what you, and in fact, it's a common question. Well, what are you going to charge me? And sometimes advisors will say, well, the good news is you're not going to pay me anything. That's not good news. That's bad news, because they're getting paid from somebody.
Yeah.
They're usually getting paid by the investment sponsor. And where that hot tip of the day came from, again, I would sit in these meetings and an investment manager would come through town and buy us a really expensive lunch. And they'd say, here's all the reasons why you should put clients' money in our portfolio, right? Because we were the gatekeepers. And they said, but here's the kicker at the end over dessert. It was, oh, by the way, any money that comes into the portfolio this month, you're getting an extra bonus on. So all of a sudden, right, you get a call from the advisor, hey, we got a hot tip. This fund's ready to take off, right? Whatever. Well, it was a hot tip for the advisor, not the hot tip for the client. That's the reality of it. The point of that is to say there's a bias. There's an inherent bias in terms of how people work. We're all loyal to who pays us. So I only get paid from one person, and that's our client, and that's who we're loyal to. We aren't here to sell you an investment. We don't do that. We are here to educate, support, and service you and help you move towards your goals. And so you actually have somebody on the same side of the table with you. And to me, again, it's one of the big benefits of dealing with specialized in a service provider. So if that sounds interesting to you, if that sounds like a resource you may want, what I will also then offer up is that we just launched a free offer, and it's on our website. It's my latest book for free, along with a strategy session with the self-directed specialist at Specialized. Both those things are free, so they'll answer all your individual questions. They'll work with you on that custom plan design if you'd like to get that done. But that would be free, and there's a ton of information and resources available there for you to explore to see if self-directing is right for you.
Wow. Edwin, it's been incredibly helpful, incredibly insightful for other people to understand. I think you've done a good job, too, of giving them resources just now, some free resources. Yeah, I guess last of all, where can people, your contact information, your guys' website, so if somebody does want to start their self-directed IRA, they can get started?
Yeah, so go to www.specializedtrustcompany.com. That's the URL, so it's just the name of the company. On the front page of the website, you'll see at the top right, in bold letters, our 800 number, so you can call in and tell them that you saw me on this podcast with Casey and that you wanted to get the book for free as well as get a strategy session scheduled. Or there's a form right there on the front page of the website. You can fill that out. It'll go to the team, and they'll follow up with you.
Love it. And that was going to be my other one, was how do people, if they have follow-up questions, like specific ones. But sounds like that strategy session is perfect. Good way to answer kind of these one-on-one.
Yeah, the reason why we came up with that is because there's some general questions that we all have, which we've been covering a lot of those, right? But then more importantly to people, it's like, well, this is what I have. How can I use this? That's very specific, right? So having a one-on-one resource is incredibly valuable to people who are going down this path or thinking about going down this path, right? There's a bit of an education to it, not difficult and not lengthy. But we're there to educate and provide, all the support that a client would need.
Love it. Well, thanks again, Edwin. And we thank all our listeners to tuning in for this one. I think you guys got a ton of value today. And hopefully we got some new people that are going to take that plunge and give self-directed IRA a shot. But thanks a lot, Edwin.
All right. Thank you, Casey.
As you may have learned by tuning into this episode of Gregor Sense, The easiest way to make real estate investing hard is by going at it alone. So as you continue learning and seeking knowledge of the industry, I want to encourage you to build relationships with other professionals who are passionate about real estate. Whether that's an agent, a business owner, or a managing investor like myself, there are pros that want to see you succeed and are willing to help you by sharing their experience. You can always reach me by visiting caseygregerson.com and scheduling a call. I look forward to connecting with you and continuing to share my experience with you here on Gregersense Mobile. Until next time, I'm Casey Gregerson. Thanks for tuning in.